Whenever you hear about fractional real estate, it's almost always about the good stuff, right? That dream of passive income, seeing your investment double, owning a piece of some incredible US property. But what if the real secret to winning in this space isn't just about chasing those amazing returns? What if it's about something much, much smarter?
And that right there, that's the big idea for this whole explainer. We're going to flip the script, move away from the hype, and get into a truly professional mindset. Because, you see, the difference between a great investment and a story you tell your friends about what not to do, well, it's not luck. It's about interrogating risk. So, let's get into it.
So here's our game plan. We'll start with the risk that most people just completely overlook. Then, we'll talk about why risk in this world is a totally different beast. After that, we're diving deep into the 5 core risks you absolutely have to understand. And we'll wrap it all up with a real, actionable framework and a whole new way of thinking about risk itself.
On the surface, fractional investing looks so simple, doesn't it? You put in a smaller amount of money, you get a piece of a huge asset, and the income just flows in. But that simplicity, well, it can be a little dangerous if you don't look under the hood to see what's actually powering the whole thing. And this is a huge point. So many people fall into the trap of treating a fractional share just like a stock. But it's not. You're not just trading some ticker symbol on a screen. You're an owner of a physical, real-world asset. And that changes everything about how you have to think about risk. Let me show you what I mean. So, with traditional real estate, it's pretty straightforward, right? It's a yes or a no. You either buy the whole building or you walk away. But with fractional, you've got this distributed ownership model. And when you distribute the ownership, you're also distributing the risk, slicing it up into all these different layers.
Okay, if you remember one thing from this explainer, let it be this. The risk doesn't just, poof, disappear because your check was smaller. No way. It just gets spread out. And if you don't know exactly where and how it's being spread, you're basically flying blind.
So the smart investor, the one who comes out on top, starts asking questions. How exactly is this risk being distributed? Who am I actually giving my money to? And what are the rules of the game here? Answering these 3 questions, that's what separates the pros from the amateurs.
All right, let's get to the main event. We're about to break down the 5 absolute must-know risk categories. Think of this as your essential checklist, the things you have to vet before you even think about investing.
First up, asset-level risk. This is the bedrock. It's all about the actual physical building. I mean, is it a great property in a great location? How's the condition? And maybe the most important question of all, who's paying the rent and are they going to stick around?
To figure this out, you got to ask some sharp questions. A building that's already leased to a big credit-worthy company for the next 10 years, that is a universe away from an empty speculative building where they're just hoping to find tenants. You also need to know the plan. Is this a quick flip or a long-term hold?
And check this out. Here's a number the big institutional players watch like a hawk. The pros use debt ratios to measure stability. And according to Nari, the most solid, stable properties keep their debt under 55%. That's a number you should definitely be looking for.
Okay, risk number 2, the operator. Look, in this game, you're not the one managing the property. You're trusting a platform to do it for you. So their skill, their honesty, their entire operation is directly wired to your bank account. They're a huge part of the equation.
So, how do you know if they're legit? You look for proof, hard evidence. Are they playing by the rules of U.S. regulators like the SEC? Do they have a third party, like a bank, holding your funds, not just them? Are their financial reports audited, standardized? A big yes to these tells you you're dealing with a serious professional outfit.
Number 3 is liquidity risk. And let's be crystal clear about this. Real estate is not a stock. You can't just click a button and sell it in 5 seconds. Now, fractional ownership definitely makes it easier to get out than selling a whole skyscraper, for sure, but you still need to know the exact rules for cashing out. You have got to know how you get out before you get in. It's that simple. Does the platform even have a secondary market for you to sell on? Are you locked in for a certain number of years? And how do they even decide what your share is worth when you sell? A clear, transparent process for this is a massive green flag.
All right, now for the one that trips up so many people, especially global investors, compliance risk. This is all the legal and regulatory stuff that makes sure your ownership is real and protected. Get this wrong, and you could be looking at a legal nightmare instead of a passive income stream.
So here's what to look for. You want to see that the investment is structured under a specific SEC exemption, like Reg S for international investors or Reg D. That's a huge sign of a proper legal setup. You also need to know exactly where your funds are being held and that they can provide you with the right tax documents. These details aren't just details, they're everything. And finally, the big one. The risk that's just out there. The stuff you can't control. I'm talking about interest rates, inflation, what's happening in the world. Now, you can't stop these things from happening, but what you can do is pick assets that are built to handle the storm.
And here's a perfect example. Some commercial properties, like those with net leases, are structured to do really well when inflation is high, because the rent goes up automatically. This data from Bloomberg Intelligence is pretty wild. It shows that these specific assets delivered an average return of over 8%, even during all the rate chaos in 2023. See? Structure matters.
Okay, so we've identified the 5 big risks. We know what to look out for. Now, how do we pull this all together into a smart, repeatable strategy? Let's walk through a framework the pros use.
It's a 5-step process. Step 1. Always, always, always start with the raw data on the asset itself, not the glossy advertisement. 2. Dig into the platform's governance. Who are they? Are they regulated? 3. Read every single word about your exit rights. 4. Ask them, hey, how does this investment perform if interest rates go up? And 5. Make absolutely sure they're ready with the tax documents you need.
And when you start doing this, something really amazing happens. Your whole mindset about investing begins to shift. You stop seeing risk as something to be terrified of, and you start seeing it as a tool for getting clarity.
Because here's the thing about risk. It's not the boogeyman hiding in the closet. It's just the language the market uses to tell you the truth about an investment. Your job is to learn how to speak that language. Because access to these cool assets is great, but access without understanding, that's just gambling.
And that really brings us to the ultimate takeaway here. The goal is never to find a zero-risk investment, because, spoiler alert, it doesn't exist. The goal is to understand the risk, to measure it so well that you move from a place of fear to a place of mastery. And that's our look at how to properly assess risk in fractional real estate. If you want to dive a lot deeper into this whole analysis was actually adapted from a report by Raveum. They're a platform that specializes in exactly this kind of thing, compliant, pre-leased U.S. commercial assets, specifically for global investors. You can find their original analysis and see how they operate at www.raveum.com. Thanks so much for watching, and make sure you follow for more explainers just like this one.